Good morning, everyone. Welcome to this rundown for global stocks and commodity markets for the 25th of March. And look, it was a pretty nasty finish to the week, I guess, as everybody knows. The market was running along quite calmly and smoothly, and then Donald Trump, of course, throws a spanner in the works, and the market went down severely on Thursday and Friday. So it really begs the question about where to from here is the obvious question that I'll be trying to answer today. So in this update, I just want to provide you with a perspective, a factual perspective on what has just happened, not one that's based on emotion. So there's no need to panic. What we're seeing in the market is quite normal. It's certainly being made worse by this one-off trade tariff issue. Without that, I think the market would just be quite calmly moving along. But look, the backdrop is that the US economy is in good shape. We've got a program of gradual rate rises that is everybody's known about for in excess of 12 months. Inflation is under control, and the Fed, under the new chairman, who seems to be getting the thumbs up from most of the financial community, has got a pretty positive outlook on things. So that's the current outlook. Now, the possibility of all of that suddenly falling apart because Trump wants to impose some trade restrictions is just purely speculation, and the market has reacted to that speculation. Now, as investors, you want to ask yourself the question whether you want to react to what is just purely speculation and the market responding to that. And in fact, I'll go even further than it's not just really the market that's responding to that. It's not people who are making decisions. A lot of what occurred in the last 2 days was just purely algorithmic program selling. It's computers just doing what they're programmed to do. There's not actually a value judgment standing behind that sell-off. And that's an important distinction to make. Of course, I'll be looking at the normal stock and commodity trends, and quite interesting because not all commodities went in the same direction last week. Also last week in Portfolio Analyst, I looked at some Australian large caps, which was quite interesting, with one that was a worthy contender, I guess, and also provided a global industrial supplier recommendation, a large cap American stock. I just want to cover one specific thing, and I introduced some information last week about the bond market, and I know that most people don't understand the bond market and they could care less about the bond market. And similarly, in something called the euro dollar, I'd imagine that 90% of eyeballs will roll back at this point in time, and you're thinking, why the hell is he covering this topic? I just mention it because it's something that I watch with keen interest, because it has the potential to impact very, very significantly on equities markets. Now, I don't expect the general audience to be interested in it or to track it, but I just wave the flag because it's just one thing that does bear watching. So something called the euro dollar, which is a absolutely key source of global financing. It provides the majority of global financing. And basically what the euro dollar market is US dollars that are held by banks outside of America. So it doesn't relate to the euro or the European market only. There are euro dollars traded in China, there are euro dollars traded in Japan, etc. So it's just the major source of funding outside the US. Now, the interest rate on that has been rising quite steeply and faster than the Fed is raising interest rates, and that just increases stress on the financial system. That's the key point. A rapidly rising global interest rate does increase stress, and particularly when it's rising more steeply than the Fed rate. Now, what this means is, or what it represents is, a version of what happened in the GFC. So what led into the GFC was a real tightening up of global credit, and a rise in the credit rate. Now, I spoke about this last week. I talked about the fact that I'm watching the bond market because the credit risk, or the apparent credit risk, is rising if you believe what the rates are saying. Now, that may or may not turn out to be true or not, but basically that is what led to the GFC, a tightening of the credit risk, and leading to ultimately a liquidity crunch. So what we're seeing is something that's heading along those same lines, and if that is the case, then it could certainly inhibit uh, economic global growth. But the key word here is could. It hasn't happened yet. It's early days. It's something that bears watching. But I think I was a little confused why the US banks sold off so relatively heavily on Thursday and Friday. They sold off more than the S&P and the Nasdaq sold off, and that confused me completely until I did some hunting around. And I think that this issue with the euro dollar is a part of that's being reflected in the banking sector, because, as you know now, I've been saying for a long time that this was a perfect environment. Rising interest rates, tax cuts in America, massive infrastructure spending, was just such a perfect environment for the banks. And I couldn't understand why the banks sold off so heavily on Thursday, Friday, but I think this could be a part of it. But look, it's something that could reverse itself, pretty readily. So let's not get too hung up on it. But I just wave it as a bit of a flag that certainly would have more substance than what Trump is doing. I don't think Trump is stupid enough to end up in a really serious trade war. I think he'll negotiate or back away from things first. But certainly, if this credit risk in the global funding market starts increasing further at a quick rate, then that certainly is a more significant issue that would concern me. So let's look at American stocks. The S&P index was lower by 6% on the week, so a real smashing in the last 2 days. It's the biggest weekly loss in 6 years, so it was significant. But the question I'd pose is, did Trump's announcement on tariffs, which, I mean, he's been talking about this now since he was elected, and certainly ramped it up in the last 3 months, did his announcement on tariffs actually change anything? I mean, that the move on tariffs started in the first week of February when we got that correction and the market fell sharply. So it's been on the agenda. The fact that he actually signed off on it and held up a document for the cameras, does that actually change anything at all? And my answer is no. So I think it's a gross overreaction to be responding to what is a maybe. And I think a large part of the move that occurred on Thursday and Friday was due to the computer algorithms just kicking in and doing what they're programmed to do. They sold off. We had a key support level was broken. That would have triggered more selling. So I just think it's all speculation at this stage, and it's not something that you want to be overreacting to. The reality is that the US economy is growing at an average of 3% per annum, and it's accelerating on a quarterly by quarter basis, and there's no recession in sight. So that's the fact. Another fact is that corporate earnings growth is strong, and it's continuing. It's continuing, if anything, to accelerate. Hasn't reached a peak. And from a valuation perspective, the forward PE for the American stock market is 16.4. Well, that's slightly above average, but given that interest rates are still quite low, that is quite a reasonable forward PE situation to be operating from. So the economy is not a problem, profits are not a problem, valuation is not a problem, and inflation is not yet a problem. So that's the reality of the backdrop. Now the US dollar still holding a base, just really moving up and down in the one spot at the moment. So let's jump in and look at some charts. So here's the S&P index. Uh, these two upper and lower trend lines. Now I do this often. I haven't moved them from last week because I want to see how the market will actually play out over time. So last week and for several weeks now, I've been making the point that this line here was the trend line for 2016. The index moved barely above and below it, 1 maybe 2% at the most. We then got a parabolic extension in January, which always had to come back to trend. Came back to trend, overshot as is normal, and then we're continuing to fluctuate up and down on either side of that particular trend line. Now, up until Thursday, or up until Friday, I should say, we'd remained within that trend channel, which was tracking higher at the same rate as 2017. Now, Friday dropped out of that trend channel, went down to the 200-day moving average, so we're now at a key level. If the 200-day moving average breaks, then that will bring in some further technical selling. There's no question about it. That's what the computers are programmed to do. But it is interesting that on Thursday, the market moved down to be equal to this previous low. So before Friday, we had higher highs and higher lows. Now, Thursday, we finished on that level. Friday, when it opened, the market quickly went underneath. That would have triggered the program selling, and then that selling occurred then all the way down to the 200-day moving average. So at the moment, looks very much like this is just being driven by the technical selling of the computer programs. And when you look at the backdrop, the fact that everything really is so positive, it's not hard to assign most of this drop to a technical overreaction on the part of the market. Now, I can't tell you that the market now won't go lower because it's possible that Trump can come out with anything on any given day. And then the market, of course, can overreact to that. And when it's in nervous mode, then that's what it tends to do. So there's no way that I'm going to say that this market can't possibly go lower, but I'm pretty confident in saying that if it does go lower, then the bargains just get better and the rebound is going to be that much steeper because it'll be selling of quality stocks that are in great shape with good valuations, and that's a recipe for very solid investing. So I'm not perturbed by what I'm seeing. It's emotionally can be a little bit difficult when you watch the value of your account go down very quickly over a couple of days. But please, everyone, just keep this in perspective. What is really going on here? Let's just look at a few other of the sectors. So we'll look at the Nasdaq. So this is the QQQ ETF. It's still well above the February lows, and it's still well above the 200-day moving average, and therefore it's still outperforming the S&P. And we also formed a new high post the February correction as well. So there's been a fair bit of commentary over the weekend about how the Nasdaq did worse than the S&P, and that all of a sudden all the major tech stocks are falling apart. Well, that's not actually a true statement. Facebook is getting smacked because of some issues specific to Facebook that I'm sure you've read about. But as far as all the other major tech stocks go, they're still outperforming the S&P. So everything there is in reasonably solid shape. This is the Russell. Up until Thursday morning, the Russell looked like it was primed to break out. We had a very steep uptrend, very steep channel. Looked like it was going to get back and challenge the January highs. Then, of course, Thursday and Friday turned that around. But again, you've just got to ask yourself, is this just an overreaction of the market? And at this point in time, I would rather stay with that scenario until proven otherwise. And over the last few years, if you've been watching these videos, you know my mantra, and that is that you respond to what the market shows you, not what you think the market is going to do. And I've found that that's stood me in good stead all the way through, and that's what I'll continue to do. Just observe and respond to what the market is saying now. Let's look at Aussie stocks. The Aussie dollar fell to 77, so it was under 77 at the start of the week, had a bit of a bounce, and then back down to 77. Our index lost 130 points, or 2.2% for the week, but undoubtedly there'll be more selling on Monday, and it could be nasty. I think the important thing, and this is really getting back to the headline of this weekly video, and that's our index broke a declining wedge to the downside. And last week I covered this. I said that it would resolve obviously one way or another, and that I felt that if anything, I would probably have to lean to the downside because our banks are looking fairly shaky, and of course that's the way that it played out. And I would expect that our banks will encounter some heavy selling on Monday. So they were the biggest drag at the end of the week, and I think we're going to see more of it. And of course, one of the consequences of this euro-dollar issue is it's probably going to hit Australia and Australian companies harder than just about anywhere else around the world in the major economies, because it certainly could have an impact on global trade, on commodity prices, and certainly on the ability of our corporates to borrow internationally, which is where most of their funding comes from. So this euro-dollar issue, if it escalates, is likely to have an outsized impact on our market. So let's take a look at the ASX 200. So there was the wedge pattern that I had last week. Didn't change anything there, and we dropped out of that range, or out of that wedge. And I would expect that we're probably heading down in this direction. So more support down around 5,600 points, and that was another key level that extends back here, really back to 2008. So we had a little look outside this range between 5,600 and 6,000, but I think we're going to revisit the bottom of the range now. Just while I'm here, let's look at gold. So that was, you can see gold did spike up at the end of last week, and that was really in reaction to some fear about what a global trade war may look like. If we take a look on a weekly chart, you can see we're still tracking higher at a big picture level, but as I've been showing now for a long time, we need to get above 1,400 on the gold price to signal any sort of change of character of that market. If we look at GDX, you can see a little bit of a kick up in GDX, but some of the global majors are not really responding to the gold price. The Australian gold stocks are doing really well. The Australian gold producers are doing really well, but globally you can see there's very little response in the gold market, which again suggests to me that that we're less likely to see gold break out above 1,400. So precious metals, gold was up $32, and that was really a bit of fear coming into the mix there. And of course, that's what I've just said with respect to GDX and the Australian producers. I'll just make the point too that there is actually quite a bit of volatility around Australian explorers. So these are some of the really speculative stocks, and whilst they may continue to move higher, these are the sort of stocks that really get absolutely fried in oil when if the market gets a bit unstable. So if you are playing heavily in the Australian resource speculative sector, just be very careful. And I know that from Portfolio Analyst, I'm getting some questions about that Aussie resource, highly speculative end around gold, around lithium. Just be really careful in that area when markets start to get unstable. Copper slipped down to $3. Crude oil, however, surged up almost to $66. So it was a big week for oil, and that was really because of falling inventory levels. Now, it's expected that within 12 months, America is going to be the world's largest oil producer, that they'll go past Russia and Saudi Arabia. And, who would have thought that would be the case 5 years ago when America was just such a prolific importer of oil. The Explorer Producer Group actually rose 1.6% on the week. So almost the entire American market got hit fairly firmly on Thursday and Friday, but the Energy Explorer Producers as a group rose 1.6. And when I delved into that, I found that some large cap and mid cap energy stocks were up nearly 10%. There were lots of gains in excess of 5% across the week. So when you see that, when the general market is down 6, 7, 8%, it's pretty easy to see where the momentum is. There's the spot copper chart back down to $3, and there's oil again back at 66, and that's a new medium-term high for crude oil. So to wrap it up, my strong advice would be avoid overreacting to these price movements. You haven't lost money, in inverted commas, until you sell. If the price goes down and then it rebounds, then you haven't lost any money. Now, I know that it's emotional, but you've just got to try and keep things in perspective. Now, I've been just pummeling this point over and over and over again for years, and that is that most of your activity should be in high quality growth stocks. That's where the profits have been, and that's where you also avoid the downside. I can tell you in the American market, whilst it's gone up dramatically over the last 2, 3, 4 years, that there are stocks that are in extended downtrends and have been for years. Stocks like General Electric, which was, I think it may have, in fact, at one stage been the world's biggest company. Stocks like Procter & Gamble, Kimberly-Clark, these are some of the world's largest industrial and consumer companies. If you have a look at their share prices, they are in significant decline, and there's literally hundreds of them. So it's possible in the last few years, if you're in the wrong stocks, that you could have actually lost a lot of money. So your focus should be totally on high quality growth stocks. And that way, if your timing's a bit off, then you just wait it out. If you focus now on buying some high quality growth stocks that are now getting down into bargain territory, and the market goes down a little bit further, then it's really nothing to worry about, because they're almost certainly going to bounce back again. So that's where most of your activity should be. And I know from correspondence with a number of people, both within my memberships and outside it, and also questions that I get in Portfolio Analyst, I just have the sense that some people out there have a very significant portion of their portfolio that are not in high quality growth stocks. They're in all sorts of other things. And that's where, in a more protracted market correction, you can get into trouble. Yes, make necessary adjustments. If your portfolio is not predominantly in the high quality growth stocks, then you may need to make some adjustments, and you should make them sooner rather than later. Because, as I said, I can't tell you that the market won't necessarily go down further. But one thing you should avoid is panic selling, selling the high quality stocks that have been bought at a decent price. Just a final thought on this. This is not a top, irrespective of what plays out in the next few weeks. This is not a top in the market. The preconditions are just not there. There is no bullish sentiment. There is no excess. There is no economic rationale for a top in the market. So that's just not going to happen at this point in time. Portfolio analyst this week, of course, I'll be hunting for bargains, and there's just so many opportunities that are starting to open up now that it's very, very exciting. So if you wish to partake of a free trial in Portfolio Analyst, then of course that's available, and the details are just below this video. There's my contact details for those that wish to correspond outside the membership, and I'll be back with you next week. Cheers.